At the midpoint of 2026, the good news is that markets appear to have passed the pressure test. Geopolitical conflict has disrupted commodity markets and supply chains. Inflation has moved higher, and interest rate expectations have been repeatedly repriced. Yet, despite those pressures, growth has remained intact, supported by strong earnings, healthy labor markets, fiscal stimulus, loose financial conditions, and continued progress in artificial intelligence. The result? Our outlook for the second half of 2026 continues to be a constructive one, albeit with more restrained economic growth. We continue to assign roughly a 20% probability to a U.S. recession over the next 12 months. With that being said, we have several watch points that will pressure test the environment for the rest of the year. First, the duration of the Iran conflict. So far, markets have largely weathered that initial shock, but as inventories are drawn down and fiscal offsets begin to fade, the economic effects could become more pronounced. Second, supply chain pressures reflect a broader shift toward a less synchronized global economy. As trade, manufacturing, and energy networks become more fragmented, inflation risks increase, with Europe and Asia facing greater exposure than the United States. This leads to our third watch point, which is interest rate volatility. With rising inflation, the prospect of central bank rate hikes is now front and center for investors. This creates risks as well as opportunities in fixed income markets globally. Even if growth remains on solid footing, the second half of the year may require greater selectivity and diversification as inflation risk, policy expectations, and market leadership become less synchronized. Looking ahead, the focus is shifting from accelerating growth to sustaining resilience, a test that will define markets in the second half of the year.